How many of y'all have ever been in a WeWork? Have y'all ever been in a WeWork location? I have. Thank you, Road Glide Ace. I love you too, and I love the show. Have y'all ever been to a WeWork location? I have. WeWork is an organization that is all across the country. And basically what it is it's a business that allows for you to be able to work outside the office. Now that sounds crazy considering that we just came out of a pandemic, right? Their business model had to be hit hard. I've even seen people try to copy WeWork's thing or their business model on a much smaller scale within their city. I knew that WeWork was dead a long time ago. I knew that WeWork was going to zero a long time ago. Let's explore it because they've recently filed for bankruptcy. This is the Wall Street Journal's take on it. WeWork has recently filed for bankruptcy and basically became a penny stock.
WeWork, once a venture capital darling, has filed for Chapter 11 bankruptcy. The filing marks a stunning reversal for the desk rental giant that was once valued at $47 billion.
WeWork was the poster child of the unsustainable startup frenzy of the 2010s.
I agree.
A rise and fall so dramatic, it was characterized in an Apple TV series.
Shout out to Stanley. I appreciate you.
The smart guy?
And Jocelyn.
Crazy guy.
Jocelyn. Wait. What is that? Is that an ad? Oh, no, that's not an ad. Thought that was an ad. Shout out to everybody that's just now viewing the show for the first time. I appreciate y'all for tapping in.
Are you crazy enough?
I may be.
Here's how WeWork went from being one of the country's most valuable startups to a bankrupt penny stock, now worth a fraction of its peak value.
Could you imagine a stock going from $44 billion or a company going from $44 billion valuation all the way down to the $400 million, maybe even a $44 million valuation? That is insane. That is more than a 90% drop in valuation.
WeWork, co-founded by Adam Neumann, specialized in leasing shared workspaces in metropolitan areas around the world.
We're a company that builds communities. We have our mission, our main thing that we do is curate and create culture.
WeWork was founded in 2010, right after the global financial crisis, and it basically seized on this casualization of the workforce that was emerging after that.
WeWork raked in funding from a roster of major investors, from venture capital.
Look at these investors. Look at the people that then fund a lot of these startups and participate in the early IPOs of some of these darling companies.
From a roster of major
Japanese, Chinese companies, JP Morgan and Chase, Goldman Sachs, Benchmark, T. Rowe Price, Fidelity Investments. All of these companies are participating in the success or failure of these companies, which basically tells you that they are not the smartest ones in the rooms either. They're just speculators in the same way that a lot of these other people are speculators also.
Investors, from venture capital firm Benchmark Capital to banks like JP Morgan and Goldman Sachs.
The founder, Adam Neumann, was able to convince all of these people that WeWork was a disruptive tech company that was going to do to the office market what Facebook did to sort of social media and what Uber did
Reading that super chat shortly.
Transportation. They ended up raising over $10 billion for what was effectively a real estate company worth a lot less than $10 billion.
In 2019, WeWork hit a peak valuation of $47 billion
That's crazy.
and took steps towards an initial public offering.
So in 2019, let's break this down. A lot of people are not familiar with IPOs. An initial public offering is a company that is valued by the banks at a specific amount, and they're looking to go public, right? A privately owned company that has a lot of different investors as a part of the early process or the early IPO or the early investment process. And in 2019, now let's remember, 2019 was right before the pandemic. Valued at $47 billion, That's the private market valuation of WeWork, and IPOing of it then makes everybody rich. It's supposed to make everybody rich. A lot of times y'all go to work at these startups, or you go to work at these companies that is not IPO'd yet, and the compensation package is much lower, but the stock options are much higher. And why they do that is they incentivize you to then do that because they can't necessarily pay you as much as some of these other companies, the Googles, the Facebooks, the Meta, the Teslas, the Fords, whatever it is that you work for. You then make an investment in that company, hoping that they become successful and eventually IPO, so that you can then convert the shares that they give you. That's the other version of the compensation that then comes along with it. They give you shares that eventually make you rich, right? The early developers of Facebook, the early developers of Tesla, the early employees of these companies, the early employees of Apple, they get so many specific shares that eventually, hopefully, will then translate into becoming very, very rich, becoming instant millionaires. And that's why a lot of people moved over to and work for or have signed up for a lot of these companies throughout the years, all through the 2000s, 2010s, and so on and so forth, because eventually it will make you filthy, filthy rich once these companies IPO. And that's the appeal. That's the pitch that they then give to people.
An initial public offering.
At the time, the private tech startups were seen as this really sort of powerful engine of the future economy, and there was a lot of optimism about them. So they get ready to go public and sort of reveal their numbers to the world, and people kind of wake up.
While WeWork's revenue was growing, so were its expenses. Despite raking in billions in funding, WeWork had yet to announce a profit since its founding in 2010.
You know what other companies have problems becoming profitable? The Ubers, the Lyfts. There's a lot of companies. Back then, one of the reasons why I was very low on Tesla when they first started coming to prominence and everybody was jumping on a bandwagon is because I didn't see the profitability, but I also didn't understand it to the point to where I seen the vision of Tesla actually being a technology company, because I was sliding them against the Toyotas, the General Motors, the Fords, all of that, right? I envisioned Tesla as a manufacturing company of cars. I did not look at them as a technology company. So what happened was when Tesla was largely unprofitable all throughout the years, all the way leading up to they're now turning a healthy profit. And not only are they turning a healthy profit, but they also have higher margins, much higher margins, and able to drive out the costs of the manufacturing process, which allows for them to be a lot more profitable per vehicle sold. And then also on top of that, them being a technology company, meaning that they spent a lot of money building out the infrastructure. They've spent a lot of money building out the Tesla superchargers to now get widespread adoption. They spent a lot of money on software engineering instead of spending a lot of money on manufacturing, right? My point is this. There's some companies that you can justify them not necessarily driving profitability into the company as far as that, but instead they're focusing on growth. Amazon, for over 10 years, had very low margins and had almost no profitability before they became the juggernaut that they are today. And now what drives the profitability of the company is Amazon Web Services, right? But they were more focused on growth. So all of the money that was made from the company was then even put back into the company to continue to expand that company. And they largely used shareholders and IPOing in order to continue to grow the company. When you look at a company like a WeWork, for example, right? When you look at a company like a WeWork, they had $3.5 billion in expenses in 2018, meaning that's how much money went out the door, but they only made a profit of $1.8 billion, which is the difference of about $1.7 billion in the hole. Well, where does the additional money come from? The additional money comes from investors, because the investors are now focused on you growing, and then they're hoping for you to turn a profit, but for the market to also see the value that they see in you, which would then translate into the stock price. So when you IPO or you have an initial public offering, it is you basically going public, and then that translating into the valuation of the company. What's the valuation of a company? The valuation of a company is how many shares outstanding multiplied by, and you may need to rewind this if you don't understand or you want to revisit this. It's the Total shares of the company multiplied by the value of each share. So if you have a $50 per share, amount that you're assessing to this company, and then you multiply that by how many shares that you have outstanding. So if you have $50 per share and you got 1 million shares that's out there, how much is the company worth? Well, it's worth $500 million, or $50 million. 1 million shares times $50 is $50 million. If you have 1 billion shares outstanding, just giving you some round numbers, and it's $5 per share, well, then the value of that company is $5 billion. But the value in it is based off of what people see, right? You also have calculations that's largely different than what they used to be. It used to be based off of what the potential growth of the company is, how far it's going to go, what your profitability is, so on and so forth, right? Now it's much different because people are speculating more. In the technology world, we're speculating more, right? So we're assessing a value to the company that a lot of times can't necessarily be substantiated by the numbers. If you're looking at the numbers and you're saying, well, they $1.7 billion in a hole every single year, or even as they continue to grow, their expenses are growing much greater than what the profitability of that company is, people are still speculating because they're saying, well, they can still monetize the platform, or they haven't really grown yet, or they haven't driven out the cost, or they're still trying to expand over into different markets. Or in Tesla's case, right? In Tesla's case, they were building out the infrastructure and they were still building out the plants. So they had to catch up to the other plants as far as, the Tesla superchargers and the adoption. And so now when you see Tesla and they're driving profitability and they're able to control what other automakers are doing, while the other automakers are depending on internal combustion engine vehicles in order to, continue to put research and development into the electrification, Tesla's already built it. Tesla's already there. And so you have to be careful. The value of a company has nothing to do with its profitability. There's other factors as far as you truly understanding what the dynamics are and the money that they make and the market that they're going into and how fully vetted they are, or whatever, and so on and so forth, how much they paying, what is payroll, what's the leadership, what's the vision of that company. You evaluating the value of a company is not solely tied on how profitable they are. You evaluating the value of a company is not solely tied on the profitability. If you go by profitability, then you would say that Toyota is probably the most profitable automaker as far as the amount of units that they move on a yearly basis, the fact that they've never really had any losing quarters, they've never filed for bankruptcy, they have a great business model, they drive the cost out of the manufacturing process. But Tesla, if you look at their shares outstanding and an amount per share, is at a higher valuation than multiple different automakers combined. And that's because there's other factors that go into, including the margin per vehicle sold, the adoption rate, how they're expanding into other countries. A lot of times, for example, what analysts use when they evaluate Apple, right? When they're evaluating Apple, they're not evaluating Apple as to whether or not Apple is profitable. Apple is massively profitable. They're trying to understand multiple different factors. They're trying to understand, well, where's the growth sectors? Because iPhone, for example, may be fully vetted out or may be fully mature as far as the ability or the adoption rate or the amount of people that they can sell it to, right? What is the product life cycle? How long do people keep their phones in the United States of America versus in China, for example? What is the competition over in China as far as them evaluating whether or not the competition is continuing to take them over? Them versus Android, growing the market in India, the manufacturing costs. Apple may be a really mature company as far as the iPhone, so they're not using that as the metric when Apple start to have a quarterly review of exactly how it is that they were profitable that particular quarter. They're evaluating that versus the previous quarter. What is the growth? What is the loss? What other sectors are you starting to go into? You got a new product that's coming out. It may be the Vision Pro next year. Okay, that's a big dog product. That may be great. What is your holiday sales? Well, what is the services division going? Well, the services division is growing exponentially more than what's happening with the iPhone. So we're not necessarily worried about the iPhone because the iPhone will sustain you and it's a profitable division. But the services may be much, much greater as far as what you want to bet on for the company and continuing to grow, or how much this company is valued at, right? Microsoft on the other end, for example, may be a little bit different. Microsoft may say, well, we're not necessarily betting on services, but our cloud infrastructure, as far as how it is that we're leveraging LinkedIn, and then, continuing to go into the gaming space and how we're using the Azure platform versus what Amazon Web Services is doing versus what the iCloud is doing. So my point is this. When you guys are looking at these stocks to be able to invest in, or you're looking at a company that you otherwise wouldn't have had access to, which is basically what the stock market is. Don't look at the stock market as a day trader. Don't look at it from that perspective. Look at it from a 10 to 15 year view, but then deep dive into it. Understand every single factor and compare it to what yesteryear was 10 years ago, 20 years ago, 30 years ago. Study those financial reports, study the quarterly earnings, study the growth, study how the company is then pivoting, study the management, study the sectors that they're growing in as far as their particular business. Understand the woes or the headwinds that they may be facing as far as semiconductor chip shortages, right? So you're looking at these auto companies, and the semiconductor chip shortage may affect them because they're more technologically advanced and they're depending on other companies or the CHIPS Act or certain things that may be introduced in legislature or the infrastructure, right? The Biden administration is now have the Build Back Better plan and the infrastructure deal because they want to push electric vehicles, right? So my point is, when you're starting to invest in any particular company, you want to start to look at it holistically. You don't want to just look at the profits. You don't want to just look at whether or not it's a dividend company. You don't want to just look at, whether or not they got good management or the manager was grown within the company and they're an engineer or they're a sales guy. You want to look at every single factor. Otherwise, you will find yourself looking at a WeWork situation where the valuation of that company, because anybody that knew anything about what was going on, all it took for something such as a pandemic, because it's a services-based company, it took something like a pandemic to just bring it down. That's why I won't invest in airline stocks. I won't invest in airline stocks at all. You know why? It's not that airlines are not profitable right now, but the first thing somebody taps into or somebody cuts off when they're having a problem, whether it was 9/11, whether it's a crash in the economy, whether Airbnbs is going bad, interest rates is too high, anything that's happening, right? The first thing that they cut off is hospitality, hotels, airlines, travel. They cut that stuff out first. And so my investment philosophy, and I'm going to do a live stream next week, but I got to first post the investing in business information inside of the Patreon. If y'all not Patreon members, if y'all not bag chasers, if y'all not meeting me in person, if y'all not doing the thing that's in your own best interest, if you're taking your investment advice from people that truly do not understand or cannot break it down to you from a C student's perspective, then you are really missing out. Do not let these people use these big terms on you. The fundamentals of what investment is the same way that it is if somebody was to come to you with a business plan in real life and they say, hey, I want you to invest in my restaurant. I want you to invest in my car wash. I want you to invest in my business in person. I want you to invest in my brick and mortar store. The same way that you vet that out is the same way that you would vet out these companies that you are then jumping into the stock market for and investing in these companies that you otherwise would not have had access to. You need to tap in with people that can break it down from a C student's perspective. If they can't explain it to you like a little child, then you should not be investing in it and you should not be investing your time. If they can't explain it to you like a baby, like a C student, and they're just throwing out these terms, when I ask somebody to explain to me why they invested in cryptocurrency or Bitcoin, it's not that it's a good or a bad investment. It's that I need you to help me to understand why it makes sense. Otherwise, I'm not investing in something that don't make sense to me. WeWork is a victim, or they're the beneficiaries because a lot of people made a lot of money from it. WeWork is the victim or the beneficiary of people's ignorance. The stock market made itself available to everybody to speculate, but it did not teach you. They did not teach you the fundamentals of what investing really meant, or what it looked like, or how you would suffer as a result of it, or how you can benefit as a result of it, because it's always going to be a winner or a loser. Your ignorance, your dedication to investing your time and your emotions in the things that's not benefiting you is going to be your downfall. Make sure you tap into the Patreon. Link is in the description as well as pinned to the top of the chat.